All right, folks, good afternoon. It is Thursday, November 20th. Today, due to some conflicts in scheduling, we're going to switch up the orders a little bit, and I am kind of doing the introduction as well as a presentation here shortly. The order today is going to be a bit different. Tim Petrie is going to go second. Typically, it's Frayne who goes after me. And Frayne, who could not be here, is he has recorded a video that he's going to share with everybody here shortly. So I'm going to go ahead and start screen sharing to show get this thing kicked off. All right, so today I kind of want to do a final production cost outlook as we head into, or production cost prediction outlook as we head into the spring planting season. I did write an article in the Ag by the Numbers newsletter on this exact topic. I have updated a few things since the newsletter was published and sent out, but I am going to elaborate on things a little bit more than I was able to in a newsletter. So the things I'm going to cover today are just our major production cost items for most crops, most of the major crops in North Dakota and the Northern Plains. So we'll start with our fertilizer index. And so when the Fed makes an index, basically all they're doing is they're taking all the fertilizers, average prices, and comparing them to what they were a year ago, and whatever the baseline year is, that index number would be 100. So if all the fertilizer prices in essence went up 40%, then the index would be 140, right? So it's just a way to benchmark how much price changes have occurred. And when we look at what's happened the last few months of really a lot of 2025, almost the index has been trending upwards. We're nowhere near the inflation adjusted uh, all-time high, really, or kind of tied for the all-time high of 2022, but we are significantly above fertilizer-wise where we were in 2024. And it looks like that 2026 to start the season may be higher, and we'll kind of dig into each product here real quick. When you look at anhydrous, we're starting to see the seasonality of anhydrous occurring. Now, I know we don't use a ton of anhydrous in North Dakota, but they do use it in the Central Plains, Iowa, Illinois, Eastern Nebraska, Kansas, etc. And it's good that they do because it gets those farmers fertilizer applications done earlier and puts less of a strain on things like urea and UAN. And that's why you see that anhydrous seasonality really starts October, November, December, because that's when those products are being applied, getting ready for spring. And and we're seeing that anhydrous is kind of trending along its seasonal line so far. And the good news really is on the fertilizer front, as an aside, the fact that it's been a pretty mild fall, not just in North Dakota, but the Central Plains, a lot of that late fall field work is getting done, which hopefully is going to dampen that impact or that demand for urea, which is going to be good news for us. If you look at potash prices, they are above where they were a year ago by about $40 a ton. Uh, Below that 5-year average, which kind of peaked back 2022 and 2023, really dragging that average up. But it's pretty much been moving sideways now for months and months and months, right at about $485 a ton, and that's kind of where we sit. I anticipate this is going to continue probably well into spring of 26 into next year. Urea prices, they've come off. They really peaked back in May, and there was a lot of reasons for that, mainly that UAN was getting hard to come by, and so there were many producers who were doing some summer applications, side dressing and things like that. They were relying on urea driving those prices up. Urea is back around that 5-year average now. You look at price for 2025 mid-November prices, it's sitting right around 600 bucks a ton. Now recall that seasonality for urea that typically occurs in that March, April, May range, and we are comfortably higher than we were in 2024. Urea prices up to $100 a ton higher. So there is going to be a bit of an increase on the urea side for our production costs headed into 2026. It's looking that way. And the same thing for 1034O. That's sitting right at around $75 a ton above the 5-year average and almost yeah, about $75 a ton really over last year. So most of these fertilizer products outside of urea and anhydrous are comfortably higher than they were a year ago, so much so that it's going to be noticeable. And then there's phosphorus, which is substantially higher in price than we're looking at compared to 2024 and compared to as we look at the early part of 2025. Heading into 2026, right now we're staring at $925 a ton MAP prices and $940 a ton DAP prices, which is almost $200 a ton in DAP's case and at least 125, well, actually $140 a ton or so higher than it was a year ago in the case of MAP. And I've talked about this before. If you've heard me present on fertilizer costs and fertilizer prices, the tariffs that have been put on phosphorus fertilizers, and again, these tariffs had nothing to do with the current administration. These were about concerns. These were either basically the conflict between Ukraine and Russia concerns, or and then as well as government subsidies being put on Moroccan phosphorus exports, and they're a huge exporter of phosphorus, and those subsidies have really forced the floor price on phosphorus to be high. Then you had the fact that the Chinese really haven't been exporting much phosphorus at all, and they're a major exporter through 2025. So it's almost assuredly a supply side thing with between the Chinese not exporting, and then you have that tariff on any Moroccan imported phosphorus to the U.S. just really driving those phosphorus prices high. So let's shift gears a bit onto seed prices. Right now, really across the board, they're predicting about a 1.5 to 2% increase on most major seeds in the U.S. Corn up a little bit. You can see the orange being the 2026 forecast versus 25. Soybean seed up a bit. Wheat seed even up a little bit, and then some other crops, oats and barley. Slight increases in seed costs per acre last spring into next spring is kind of what the prediction is. Chemical costs, this would be chemicals not including fertilizers, so herbicides, pesticides, those kind of things. Again, we're seeing increases as well, maybe up to a couple of bucks an acre on your chemical side in corn, soybeans, wheat, really across the board. And the fact that it's across the board just indicates, that chemical prices are expected to edge up a couple of percentage points from last year into next year as well. And then overhead. So in this overhead chart, this includes cash rents. So this would be utilities, those kind of things, as well as cash rents. And the projection there is, again, a few, three, four, equipment depreciation, three, four, maybe $5 an acre increases in total overhead costs for most of the major crops across the United States. Then corn, soybeans, wheat, really across the board. That's what the expectation is. So there's um, cost increases is pretty universal, but in a lot of areas it's small. So in total, the stuff that I showed there, we're expecting like between seed, overhead, chemicals, that kind of stuff, about a 1.5 to 2% increase from 25 to 26, and then a pretty substantial increase in fertilizer prices. Now I do know there are some alternatives that we can do for phosphorus applications. It can be delayed in times when prices are really high, not forever, right? But for a year if need be. But right now, that's just what the cost side of things are looking at. And we're heading into a year where a 2, maybe 3%, or even 1.5% increase in production costs, there just isn't a lot of margin to absorb it because the expectation isn't that there's not going to be an equivalent increase in income. If it's a hold even, that's not a very rosy picture. So we're going to have to hope for some rebounding in crop commodity prices to offset some of what's going on here. So that's all I really wanted to share. This was just talking about that outlook here as we transition into making our spring planning decisions. I will be on at the end to answer any questions you might have. And as I said, we're going a little bit different order today. So with that, I'll turn it over to Tim Petrie, our livestock specialist. Thanks.
Good afternoon, everybody. Tim Petrie again. Thanks for letting us change around a little bit. As soon as I'm finished here, I have to head out for meetings in central North Dakota, so I won't be around for the questions. But you see my email there. If you have a pressing question, please feel free to get a hold of me. So, a lot has happened since our last time, and so I want to talk about that of kind of where prices were last time and where they were now, particularly in the futures market. Most of you are aware that we've had just a wild volatile market here in the last month. So I'm just starting off with Fed cattle prices like I usually do. And on the top is our October 9th webinar that I explained to you. And you see we had right there, prices that went down season a little bit like they usually do right before Thanksgiving because there's more interest in turkey and so on. And then usually do pick up after Thanksgiving. And so, the cash mark was at 230.76, but back then in October 19th, the live cattle futures market said we would be back up to 238.90, and that was, very much expected, very much seasonal pattern, and so on. So now let's jump down to today, and fed cattle since then, since our October 9th webinar, are off about $5, so not a big thing. But the big thing is on the futures market. These are yesterday's closes, and they're down another $2 today. So we went from right up at 239 to 214 today. So quite a decline in the futures market there. And as we go along here, for instance, let's go over here and look at the July futures that our last webinar were 237, and now today with the $2 decline, about $209. The three biggest things that affect feeder cattle prices are fed cattle prices, particularly those distant futures when those feeder cattle will reach market weight, and then feed prices, and then supply. So you see fed cattle prices now, a lot of our 750, 8 weight steers now will finish out in May or so, June, and it depends on how fast they're pushed. And so we look at the July futures, and so that has, as you can see there, has taken a big hit, and certainly affects price risk management, and some more on that later as we go along. So you know here's the futures market charts, and why did it happen? And the simple answer is we went from trading a fundamental market. Again, fundamentals are supply and demand, and we had very strong demand for cattle and funneled down into feeder cattle and short supplies. You're all aware that the cow herd went down for 6 straight years, and our beef production has fallen off 5% this year, from 27 billion pounds to 25.8, and so on. So we get less beef, and that was fundamentally, everything was strong, and talk more about specific feeder cattle in a minute. But then what happened to change us to a technical market was on October 16th. You see the green arrow up there, when we were at all-time record highs, contract highs, and everything else, and have been declining since then, and fairly abruptly a number of limit movements. And lately, although we've stabilized a little bit, you just see how wild the market is. Again, near limit movements again yesterday, down $4 or so, and on the live cattle on the top, and down another $2 today. So what happened, and most of you are aware of this, and in the box showing there is it on October 16th, just the president said, I think we have a deal on beef that's going to bring the price of beef down. That would be one product that we would say is a little bit higher than we'd wanted. He said that when the Argentine president was visiting here, and our president wanted to get him reelected at the time, and bought a bunch of Argentine pesos to help get their economy going, and so on. And also made a statement that he was going to increase the tariff rate quota on beef from Argentina from 20 million metric tons to 80 or 20,000, I should say, 20,000 up to 80,000. Now, that didn't happen, and actually, he doesn't have the authority to do that because Congress has to approve a tariff rate quota increases unless we have a declared national emergency. But then, just him saying that, and he broadly defines a national emergency as well on other things with tariffs and so on. So then, the particularly the funds were long, long, long. You see on the bottom, one of the statements that trend you or that the fund traders go by is the trend is your friend as long as it's going up, 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 buy, buy, buy. Then when it goes down, the opposite of that. And so, cattle were the only game in town, big soybean crop, big corn crop, and wheat prices so on the low level. So this was a hot market for, I'll show you the open interest in a minute, but that scared the traders. So they all bail out, and all those funds have stops on the market to save their profits that they've made, and with their algorithms and everything. And so that has just caused the market to continue down, down, down. And other issues came along as well. The Mexican border now has been closed all summer for Mexican cattle coming in. We'd be getting 30,000 feeder cattle a month or a week, I should say, now to come in and graze the excellent winter wheat conditions that we have and so on. So, there was things going on there. The Secretary of Ag going to Texas at times and, was going to make certain announcements, and the traders interpret that as we're going to open up the border. And we'll look at a minute how much impact that might even have, and when it was open before. Also, the president had placed a number of different tariffs on Brazilian beef. So it amounted to up to 76%. And there was talk that he was going to eliminate those tariffs, which he did reduce all across the board tariffs 10% here this week, but still that's too high for Brazilian beef to come in here. And then, another uncertainty is the China trade agreement that was also being negotiated at the time, which actually, at least theoretically, would be positive for beef prices because we are at the present time shipping no beef to China. We have no packing plants approved. And so that might even, but anyway, all that noise caused the market to go down and then go down to the feeder cattle market the same way. So a little bit more on what happened there is the chart on the upper left-hand corner is open interest. That's the number of open contracts that there are. And the blue line is live cattle and the red line is feeder cattle. I'm just going to concentrate on feeder cattle because that's what we're going to talk about the rest of the talk. But anyway, for all of 2024, we had about 50,000. It's a thinly traded market compared to the other markets. Look at over here on the right-hand side, the open interest in corn is 1.6 million compared to our, what was about 50,000 on feeder cattle. But anyway, then we start this year and you saw the chart up, 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 up on prices. So the funds all jumped in. So open interest, the number of open contracts went up, all those longs, the hedgers were on the short side, but the funds were going long. And so got them up to almost 100,000, almost a double in the number of open contracts. And so, you could argue whether funds are good or bad. They cause the market to go up too high when it's at high points, and they cause it to go down too low at low points. And so if you're a hedger, it may allow you to, if you're wanting to sell something to go short at a higher price than fundamentals might indicate. But that's a whole story for another time. But anyway, then there's October 16th, and they started bailing out. So open interest dropped 30,000 contracts there, and 30,000 contracts decline in corn would be no big deal because we got 1.6 million. But when we went from near 100 down to 70 yesterday, there we had 72,000 open. So all those funds bailing, just and again, that's what we say technicals. They're chart traders, and they watch the charts. and don't care much about the fundamentals and so on. So that's our problem now, is that the fundamentals have really not changed, and we have a short, demand for beef is still strong, and supply is down, and when we get to feeder cattle, looking at those, but the funds are not our friends right now, and they're just bailing out of the market, and we need speculators to keep that market liquid. So then the question is, oh, all right, if they bailed out of cattle, where did they go? And so Frayne is going to talk to you next and talk about that. But down in the lower left hand, look at where soybeans were on October 16th. And again, the president was negotiating with China. And many people think that we have now a trade agreement with China. And again, the president cannot negotiate. He can negotiate, but he can't pass trade agreements. That has to be done for Congress. So all we have is a framework for and beef was supposed to be included in that, but there's no details on beef, and we're still not shipping beef. But anyway, that framework with China indicated that they would buy some beans. And so then the speculators said, oh boy, okay, let's get into beans and let's get out of cattle. And so then they ran the market up $1.50 off yesterday, as you can see, and off again today, because China is not buying as many beans as some originally thought. And again, they don't have to. That isn't a binding agreement that we have with them in beef or anything else. It was just an agreement not ratified by Congress or anything else. So move along then. Here's the 550 weight steer prices in North Dakota. And again, they're still at very high levels, but have been very volatile. And we were at 427 when I talked to you last on October 19th. And actually, even though we've had a big volatile market, we're $10 higher than that last week. So calf prices are still doing very well. Calf prices last week were $127 a hundredweight, higher than they were last year. I know everybody looks at 3 weeks ago, there on October 16th, when all of a sudden they bounced up to 484 and back down, and that was a kind of anomaly. That's, was the first big runs of cattle, and we had everything, all those things showing up there. We had strong fed cattle prices back at that time, obviously a short supply of cattle. The Mexican border is closed. We're retaining a bunch more heifers, and maybe that's going to subside some with all the volatility we have. But, at that time, a lot of interest in replacement heifers, good winter, excellent, in fact, winter wheat crop to put calves on, and none coming from the Mexican border to put that on. So that, and new feedlot capacity down in southwestern Nebraska, 150,000 head feedlot just finished up being built, and they're going to add on to that in low corn prices. So that popped the market up. But still, we're still at for this time of the year, record high prices, and calf prices doing very well. You can see up there a number of things happen up there. Two market reports from this week that I just wanted to pull. These are USDA reporters. And the top one says, many takers for all market classes again this week. That was a report come out this week. The driver of the light calf market was a combination of southern wheat buyers that I talked about, and even northern Canadian buyers are in. Plus, go down one, there were new buyers in attendance today that are the Corn Belt buyers. When the Corn Belt buyers get their corn out of the way, and again, we got a record 16.7 billion bushel corn crop, and when they have low corn prices, they tend, those smaller feeders, that when we have $7 corn, they don't feed calves, but they want to when corn is low. So they're in the markets. All those things then have kept the calf market at at much higher levels than they were last year, although I know we did have that spike. So then we go to the heavier weight feeder cattle. Then have taken a bigger hit because, like I said, they're closer to the live cattle futures that the big commercial feedlots that buy the 800-pound steers in, that they look at what the distant futures are, what they can hedge into, and then what did they price corn in Nebraska? They put in high moisture corn earlier, and it's in there, and they price it in, and they have to feed it to cattle, so then they have to buy cattle. So again, The cash price was up there at 382 the last time we talked, and now is down about three. Has declined, as we'll see down at the bottom there, to 344. So a kind of a big hit in cash prices, and that's because those futures price went down. Corn is about the same as it was a month ago, just went up a little bit, just a little bit there. But anyway, the November futures that they actually, as soon as I guess the market closed now today, was at 369 there when we talked before, and down at 341 today, and that's closed out at right where the cash market is. But still, even though at 344, we're still higher than we were last year by $70 or so. And again, they were higher a few weeks ago, but still at, for this time of the year, record high prices. But again, the futures all across there have taken big hits. And so from a backgrounding standpoint, for instance, go back to those March futures that are now, well, the feeder cattle futures are down $4 to $5 today. So you take them down, the March futures down closer to 310 today. Just back at our previous webinar, they were up at 360. So that, has made a lot of difference in backgrounding cattle and so on. So to kind of talk about that next, we just finished up doing 5 different about half-hour videos on backgrounding that's on this website up there. Just Google NDSU backgrounding. And I've already mentioned some price outlook, but I talk more about some price risk management there. And go down to the third one down, Brian, it was just on, he did a whole bunch of budgets on backgrounding cattle, and so pay attention to that, because things are changing by the minute, as you see on the prices. Here's the market report last week, and just mention a couple things here. There's that 437 that I mentioned, but look at the wide range. These are these 3 markets they report are Napoleon, Mandan, and Stockman. So they're all, right down I-94, just one day apart, or Napoleon and Stockman the same day. So this is the same day, the same markets, and you got a $73 range in prices. So from a backgrounding standpoint, $475 cattle, you would have to have a pretty sharp pencil to make that work, given what the March futures are. But there are cheaper ones than that possibly. And one other thing I wanted to mention is these fleshy cattle really get discounted on the market. So when we're backgrounding cattle, we do want to put weight on them, and maybe 2.5 to up to even 3 pounds, but don't just throw, because corn is cheap and you got a lot of it, throw a bunch on and get them too fat, because you'll be throwing good money after bad. And then the other thing Brian mentioned on his budgets is heifers are really discounted a lot, even more so than last year. And even though we have replacement heifers selling better, the commodity heifers discounted a lot. So when you look at a budget situation, they gain on steer prices every 50 pounds till, fed heifers and fed steers are the same price. So probably some opportunity there. We always do keep a lot of heifers. So there is a cattle on feed report out tomorrow, and expected to show less cattle on feed and lower placements, and maybe the market will help to cause some of the bleeding and so on. But it all depends on what if the actual number says we're only down 1% or so on, would not be good for the market. But we'll see what happens there tomorrow. Just a word of caution now, when a new thing with when cattle on feed reports come out, LRP is not offered the day of that report, so there'll be no LRP tomorrow. And so just finish up with fed lamb prices like I always do. Nobody has said that fed lamb prices are too high. I'm being a little facetious there. So lamb prices are hanging in there very well at high levels, quite a bit higher than last year at 224.50 there on November 6th there. Sort of sold a load out of Tappan on the electronic market there at 224.50. So with that, I want to wish you all happy Thanksgiving. On the way into work this morning on the radio, there's some report that there's a shortage of turkeys, and just want to assure you. In fact, I wrote an article on turkeys on the in our newsletter that you could read. But there'll be plenty of turkeys around. In fact, here in Fargo, at least there's almost a mini war going on. That you buy a ham, you get a free turkey, or turkey's down, and plus there's all the other good meat that's available for Thanksgiving. That we have the widest choice of meat of anybody in the world at reasonable prices. So enjoy Thanksgiving, and let's hope the market gets some stabilization here and is less volatile. So with that, I'll stop sharing.
Please, Tim, give me a
Yeah, okay, I'm waiting here to make. Okay, there's him.
Hi, this is Frayne Olson,
Yep,
crop
we're
economist,
good.
marketing specialist with NDSU Extension. I'm here to talk a little bit
Okay,
about the
goodbye, everybody.
implications
all right.
for the November USDA reports, as well as give you a quick update on some of the trade policy issues. Here's my contact information, so if you do have any questions later on, please feel free to contact me or reach out. Uh, my travel schedule is really starting to pick up. So I am getting a little bit behind on some of my emails and correspondence, but please be a little bit patient. I will get back to you as soon as I possibly can. All right, so let's just dive right in and start talking about what we know. So the USDA WASDE report, the World Agricultural Supply and Demand Estimates, as well as the production reports, were released on last Friday. There was a delay, a 1 week delay, because the government was shut down. They did the people within USDA were able to compile and publish the WASDE as well as production reports, but they were late and delayed. Um, Overall, at a very high level, I would consider them neutral for soybeans, slightly negative for corn and wheat. And I'll go through some of the details in just a minute. The other thing that was released when the government did open back up again, and we're still in the process of getting more of this information, what we call the flash export sales reports were released. So what happens is when there's a large sale, if it's over 100,000 tons, basically a vessel and a half, if there's a larger sale, the company that sells that needs to report the sale and the country of origin or the country that is being shipped to within 24 hours. And so these flash sales reports are those things that hit the marketplace. There's a big sale to Mexico or China or wherever. And then we get information about that right away. So those reports were compiled, but they were not released during the shutdown. Okay, so that bundle of information was released all at once. And of course, everybody went through it really fast, trying to say, well, did we get some sales into China or not? There were some smaller sales, but not nearly what we were expecting, which again, I'll show you in detail. Now, every week on Thursday mornings, USDA releases a very detailed report of all of the export sales, whether they're big or small, by country, by crop. Okay, so those reports are coming out and being calculated and re-released on a slower pace. So the full extended reports are still going to take us quite a while before we get the full data set, we get the full information. It takes a while for USDA to catch up. But these flash reports, these quick, large sales everybody should know about, did get reported. So we're still in this process of trying to get caught up and say, well, where are we really with export sales and how much have we actually sold? And again, I'll go through this a little bit of the update on China in just a minute. And then finally, the markets right now continue to watch Chinese soybean purchases. We're always kind of hanging on the edge of our seat, hoping that we get some more. We're starting to talk a little bit about the South American weather. There isn't a lot of conversation right now, simply because Brazil is about 70 to 75% planted for their soybean crop. So the soybeans, even in the north, are just coming out of the ground. Where it's a little too early in the season to get all bent out of shape about weather and weather issues yet. But we will start over the next several weeks starting to watch that and the crop development out of South America very closely. So let's dive into the numbers we did get. As usual, what I try and do is highlight what is the average trade estimate So there's again every month there's a survey of the major traders and analysts and say what number do you expect USDA to come out with, which is highlighted in blue in the top row. And then on the very bottom in red is the number that we actually received. So if we're thinking about trying to understand and explain what happened in the marketplace when these reports came out, this really helps us explain that. Now, I did highlight just towards the bottom and highlighted in black the information that we got during the last report. Now, that was in September because we missed the October report, if you guys remember that. So I do provide that as reference, just kind of as a benchmark. So let's go through what did we learn. Well, on the production side, when we think about average yields as well as total bushels produced, the trade was expecting a decrease in production, primarily because of a reduction in yield. So we had 186.7 in September. The traders were expecting to drop to about an average of about 184. We got about a 186. So it was a reduction, but not as large a reduction as what we were expecting to see. Okay, now if you take that yield times the harvested area, you get about 16.752 billion bushels worth of corn. So even though we went from 16.8 down to about 16.7 and a half, small reduction, that is still by far a record corn crop. So we would really have to come down a long ways not to have a record corn production this year. Okay, now shifting to soybeans. On the soybean side, yes, the trade was expecting to see a slight reduction in both yield per acre as well as in total bushels. We did get that. In fact, the yield reduction is a little bit more than we thought, and the total production was a little bit more than we thought. But to be very blunt, that's right in the middle of the range. So I would say basically on soybeans, it met market expectations. On the corn, slightly negative. We're looking for a little bit more of a yield cut, but we didn't get it. One more sidebar just to try and make sure that everybody understands. The reason these October and November reports become so important is because in those 2 months, USDA provides 3 sources of data to try and estimate yield. They contact farmers and ask on a farmer survey, what do you expect to get from the crop on your farm? The second, they're using satellite imagery. And again, the composite of that satellite imagery over time to try and use and forecast yield that way. But in October and November, they also send out what they call objective yield estimates. So they actually send people into the field. They randomly select fields from around the country, and they go in and actually do yield counts. And so they actually have boots on the ground to try and confirm the numbers. So so far, it's basically that corn yield is hanging in there. All right, so now let's shift to the bottom line. What about ending stocks? And as I've said before in some of my discussions, ending stocks are important, even though they're all forecasts and estimates. But they're kind of that stake in the ground to say, well, what do we expect our inventories to look like? If we have really big inventories, we have lots of grain around, we tend to have lower prices, low volatility. It takes a lot to get the markets to move. Versus if we have relatively tight supplies, we tend to have much higher prices, a lot more price volatility. So let's start with wheat. Again, the blue row on the very top is the average trade estimate. The solid black line or the highlighted black line towards the bottom is the last report, which is in September, and then the bottom highlighted in red is the information we got on Friday. So the trade was expecting a reduction in wheat inventories, ending stocks, and we did, an increase. We did get an increase, but that increase is a little bit larger than anticipated. So there was actually several things that went on, mainly on the production side. USDA did increase the harvested acres slightly, and I do think some of that came out of the winter wheat belt, getting more confirmation about what harvested area is. We did take the yield up just a little bit. I think the spring wheat yields were a little bit better than what was originally budgeted within the supply-demand estimates, and they made no change on the demand side. So if you increase the supply, demand stays the same, our bottom line creeps up just a little bit. Again, not tremendous shifts, but it just adds one more, kind of downward pressure onto prices and saying, well, we got plenty of wheat around. Shifting to corn, the trade was expecting a reduction in ending stocks. Not a big shift, but a slight reduction in ending stocks. So you compare the black line to the blue line. And in reality, what happened was you got an increase. Okay, now again, I would not consider this to be a dramatic increase. And if you look at the trading range, I should say the range of trade estimates, which is still pretty wide, I'd still put the 2.154 billion bushels that USDA reported squarely in the middle of that trading range, or what the trade was expecting. But we're a little bit on the higher end of that instead of the lower end. So what happened? Well, a couple things. We actually got an increase in beginning stocks. So if you remember, we had talked about this before. Just before the government shut down, we did get a series of reports on the quarterly stocks report, very end of September. Now, that report takes an inventory of how much grain is in the bin. And every quarter, so every 3 months, they do this survey. Well, the September one becomes the final ending stocks for last year. So it's our final estimate of how much grain do we have in the bin just before harvest of 2025. So the question is, how much grain from last year are we carrying forward? And that number came out a little bit higher than what the trade had expected. Those numbers are now showing up into the November balance sheet. We did get a slight reduction in yield, which I noted before. We also got a slight increase in exports. USDA's forecast for corn exports increased slightly. And again, given the current pace of our corn exports, we are well ahead of last year's pace, and last year was a record corn export year. So at least there's some positive news on the export front from corn. So if you wash that all through, do the math, you get to the bottom line. We had a slight increase in our corn inventories. Again, a portion of that was actually we had more from last year that we carried forward. So for soybeans, a little bit different. We were expecting a slight decrease in ending stocks, which is what we got. So the average trade estimate versus what the report came out for from USDA, almost identical. So there's a lot of kind of consistency in the thought process for soybeans right now. Again, what happened, what caused the change from the September report into the November report, we did update our beginning stocks, or the inventory from last year carried forward. And that number was slightly smaller than what we had first expected. Okay, so we trimmed the amount from last year. We decreased the yield just a little bit, but exports also dropped. So USDA did reduce their forecast for total exports for soybeans this marketing year. Not surprising given kind of the slow pace that we have right now in the export market. Now, what is a little bit concerning is if you look at that forecast, again, it can change, but if you look at that forecast, those numbers that we're seeing right now are actually lower than the export sales we had during the phase one agreement. So if you look back in time, how far back do we have to go to get this low a number for total exports, soybean exports? You have to go back into the early to middle 2010s. So about 2014, 2015 was the last time we had these lower levels of exports. So again, a little bit concerning. It's one of the reasons that we're seeing some uncertainty within the soybean market. So let's talk about soybean exports. And again, I've explained this before, but I'll go through it very quickly. This is the most current information we have, but it's still not very current. But I do want to point out a couple things and give you some updates. So the 4 columns on the left-hand side are 12-month totals. So that's actually a marketing year from September through the end of August. So those are 12-month totals. This is how much soybeans have the U.S. sold to these different countries. Okay, and we go country by country, you can see what the trends have been. The 2 columns on the far right-hand side are a little bit different. Those represent the year-to-date sales. So starting at the beginning of the marketing year, and actually before that. So how much we sold for new crop soybeans. So the far right-hand side is the most recent numbers that we have for all of the new crops, 2025 26 marketing year soybeans. So the crop that we're just now finishing harvesting. Okay, and then right next to it, just to the left of that, is last year's for the total for the same time period. And then if you move to the left again, it's last year's total. So as you can see, based on what the information we got through the 1st of October, at that point, China still had not purchased any soybeans. But as you go down the list, some of our other countries, some of our other export or trading partners like Mexico and Egypt had actually increased their imports of U.S. soybeans. But if you drop to the bottom line, we're well behind last year's pace, again, primarily because of the lack of Chinese purchases. Now, based on those flash sales, so when China comes in and buys U.S. soybeans, they typically don't buy small amounts. They typically come in and buy multiple vessels at a time. And so that 24-hour reporting period becomes really important. So what I did was I went back through those reports as of this morning. Actually, we got a report this morning that China did purchase an additional amount of U.S. soybeans. And if you look at this 11/20/25, so this was as of this morning now, China, based on those flash sales reports, China's bought just under 2 million metric ton of soybeans. 2 million metric ton, 1.9. Well, this time last year, they'd already purchased 15.8. So just remember that 15.8 from last year. We've only got about just under 2 million metric tons so far this year. So again, we're well behind the normal pace, and a lot of that was because of the trade tensions between the U.S. and China. One other thing that I want to remind you is that our export sales are very seasonal. They're very cyclical. So what this shows, just to remind everybody, is the amount that we sell, not deliver, but the amount that's sold every week during the marketing year. Okay, so you can see from beginning about October through about January-ish, we export or we sell most of our soybeans. Now they're delivered later on, but our sales occur during this window we're in. Now the red line that you see, the kind of that dashed line, those are not the official USDA numbers. Those are private industry estimates. So I did want to plug in, this is the information, or these are the estimates that the private forecasters are having, and that's, again, setting expectations in the marketplace versus what we've seen historically. So again, so far this year, we're well behind the pace that we would normally see for exports. Now, let's talk a little bit about the framework agreement that we have between the U.S. and China. I want to emphasize this is a framework agreement. So essentially, President Trump and President Xi did get together. They came to an agreement in principle, or basically at the very high level, no details, but at the higher level about, okay, here's the agreement we're going to have. We're going to have our lieutenants, if you will, the experts come back in and fill in the gaps, write up the actual document before we actually sign something. But we've come to an agreement on what we'd like to see within these trade relations. Now, from the U.S. side, when we get information from the White House and from the U.S. perspective, the U.S. has said that China has agreed to purchase at least 12 million metric ton of soybeans this calendar year. So, from November and December, they'd purchase a minimum of 12 million metric ton. Well, so far they've only purchased 2. Okay, based on the information we have right now. And for perspective, last year at this time, they already purchased 18.9. So again, we're not expecting China to get back to the levels we saw last year. But if we can add, 10, an extra 10, if we can go from 2 to 12, that would definitely be an improvement. And it would be something that would put some lift into the marketplace. We haven't seen that yet. My comment to that is, so far we have not gotten confirmation from the Chinese side that that's what they're going to do. So now we're getting some mixed messaging from the U.S. side. This is what the agreement was. The Chinese have been asked directly, is that the agreement? And they haven't really answered the question. So there's still some anxiety and some uncertainty about, what was the agreement and will the Chinese actually fulfill what the expectations are. Okay, so then the other part to this is what happens after the first of the year. So these agreements, the numbers that I'm talking about here, are based on a calendar year, not on a marketing year. The calendar year is from January 1 through the end of December. Marketing year is from September 1 through the end of August. So we have a timing differential here. So as of January 1, at least for the trade agreement standpoint, the clock will reset. And so the expectation, at least from the US, the expectation is that China will purchase at least 25 million metric ton of soybeans from the US within the calendar year 26, 27, and 28. Again, for reference, if we go back to 2024, which is the last full calendar year they purchased 26 million metric tons. So basically, if this agreement holds and China says yes, this is what we agreed to, they would come back and purchase U.S. soybeans at a pace that would be pretty similar to what we saw in 2024. So let's hope that that happens. And then my final comment before I finish is that there's still some concern, and I think one of the reasons that China has not purchased more U.S. soybeans is that the Chinese government has not completely eliminated all of their import tariffs on U.S. soybeans. So when President Trump and President Xi got together, there was actually a 20% differential between U.S. soybeans and the soybeans purchased from everybody else. So when China buys soybeans from the global marketplace, they charge a 3% import tariff. Well, before this meeting with Trump and Xi, we were at 23% and everybody else was at 3. What in the agreement, again, it's not been confirmed by the Chinese, but in the agreement, they were going to reduce it from 23% down to 13%. So we're going to take 10% off the top. But we're still at a 13% tariff rate versus 3% for everybody else. And that additional 10% is making U.S. soybeans very expensive in the global market, at least for a Chinese buyer. So we are getting some purchases. We're hoping for more purchases. Again, at least the expectation right now in the marketplace is that what was agreed between President Trump and President Xi will be confirmed. But again, we don't have any formal confirmation of that. So with that, I will stop sharing. I appreciate your time and attention, and I hope you have a great day. Thank you.
Brian, are we doing this again next month on our regular schedule, or are we skipping December?
I believe we will be doing it next month. I can't confirm that. That would be up to Dave. I know the delay this time really had to do with the situation regarding government reports. We would have done this a week or so ago, but the delay in USDA reports coming out, both in Tim's case and Frain's case, made it very difficult for us to put that information out. So I think it'll be more on time, next month, closer to the middle of the month than this one was. I see one question. Oh, yeah. Somebody said thanks for providing the timely information. We appreciate you listening. We put these on and put these together. Hopefully you folks are able to learn something from it and take something from it. And that's why we do what we do. So we appreciate you taking the time to be with us these afternoons. So, and also I shameless plug, thank those of you who, read our Ag by the Numbers newsletter. And if anyone is not signed up yet for the Ag by the Numbers newsletter, where we put out information like this, but in, a short, concise written form, please email me, brian.parman@ndsu.edu, or if it's easier, just Google my email address, and it should be right there online. So thanks again. Not seeing any other questions. Appreciate you taking the time to be with us, and have a good rest of your week.